Now, there's very popular models in finance that have book to price indicating risk, okay? The book to price cannot indicate risk if the book to price is 1 for all firms. So take into account, for example, a money market fund and a risky hedge fund, and they're all mark to market, both mark to market. In that case, the book to price is 1 for both funds. And the book to price cannot distinguish, the risk. And it cannot distinguish the risk because of the accounting. It's mark to market accounting. And it takes away the ability of the book to price to indicate risk. Now think of industrial corporation, where you say, no, we don't use mark to market accounting or fair value accounting variant of it. We use some form of historical cost accounting, which typically gives us book to price less than 1. Now, how do you get a book to price less than 1? The way the accounting works is, given price, which is the expectation of future earnings, you only get a book to price less than 1 if the accountants say, I'm not going to book all the value now, the earnings now, I'm going to defer booking the earnings to the future, okay? That's how accounting works. So, a book to price less than 1 gives an indication of earnings deferred to the future, of earnings growth. Now take on the notion that growth, that earnings are at risk, and not only are forward earnings at risk, but long-term earnings are at risk. The more growth you have, okay, the more growth that is not yet booked into the accounting, the more risky you are. Put it this way. The way the accounting works is we don't recognize earnings on the balance sheet until we have a very low beta asset, cash or receivables, until we get the resolution of uncertainty. That is, we all put into growth until we get the resolution of uncertainty. As it turns out, it's a little bit of a tricky explanation here, unless you've really got the aesthetics of accounting. You put earnings to price and book to price together, you'll actually get this combination where you get situations where firms are reducing earnings now, deferring to the future, okay? You're picking up growth. And you're picking up growth which is at risk. Okay? It turns out that under the accounting scenario, or the way you look at value of growth, growth is redefined. Growth is risky and yields higher returns, whereas under value growth labels, growth is supposed to be less risky and yield lower returns, okay? From an accounting point of view, once you see these numbers as accounting number, you realize that the value versus growth has actually been mislabeled. Okay? Growth's risky and growth urge a higher return, and a combination of earnings and price and book to price give you that indication of growth. And that can be explanation for these differential returns. And just to finish up very quickly, here now are the 2 years ahead growth rates for these portfolios, earnings growth rates. And you see the growth rates are much higher for these portfolios down here, okay? You also see that the standard deviation of EPS growth rates is much higher for these portfolios down here, which again are the high book to price and the high earnings to price. Growth takes more shocks. And you see down here, when you look at the interdecile range, which is the 0.9 versus the minus the 0.1, you see the interdecile range here are far higher for these ones here. These portfolios down here, which exhibit those higher returns, are portfolios which give you higher expected growth, but where you actually take a lot more hits to growth, okay? You actually get more extreme negative outcomes, and you get more extreme positive outcomes, okay? And it happened over this period that we looked at these numbers here. Here is a period where growth actually paid off in the US because we got growth. But this is growth that comes with risk. And that, of course, is saying, I want to handle accounting, the earnings and book value, for the point of view of taking very simple positions as an investor, okay? And I can be naive about it. Let me just buy firms with low prices relative to book value and low prices relative to earnings, okay? And trust my luck. Well, we've got to be careful. You are actually buying growth, and you're buying risky growth. And that all comes from understanding how accounting works for valuation, okay? Which is the theme of the book, okay? There's many more stories there. The theme basically is valuation is actually an accounting problem, okay? you've got to do your accounting. And if you want to do valuation, this is how you do your accounting, okay? This is the insight you get from accounting about what you're buying and the risk you're taking on. Okay? Thank you very much.